She has so much experience working one-on-one with small business owners of all sizes and types. So I'm very excited for you to hear from her today. And so I'll throw it over to you, Rosalinda. Thank you so much.
Thank you, everyone. I'm very excited to be here. This is a brand new webinar that we are basically introducing to you today. We haven't done this type of webinar called Get Approved. So it's going to be very insightful in sharing things that we're seeing on applicants, in applications from different borrowers lately. So who we are, we're going to talk about who we are. We're going to talk about how you can identify your strengths as a borrower and what areas you need to improve. We want to let you know what the lenders are looking for in terms of documentation and why they're asking what they're asking for. And what kind of lender should you be looking for in order to fund your business, depending on what type of business you have. So who we are a nonprofit 501c3 organization. We are also called a community development financial institution. That is a certification that we receive from the Department of Treasury of the United States. We're also a mission-based lender. Also, you can, if you hear mission-based lender, is pretty much a similar thing. We are here to open doors primarily to people or borrowers that are historically have had less access to capital because they are either entrepreneurs of colors, women, immigrants, low to moderate income entrepreneurs. And we want them to be able to help to build prosperous businesses and livelihood for themselves and their families. Traditionally, it's very difficult as a new business owner or a person of color that owns a business to be able to access capital. Actually, it's difficult for any startup to access capital. It's almost impossible. And after this pandemic, it has become a lot more difficult as well. So we have been serving the Southern California region since 1994. We recently expanded to the LA and Orange County area. We also service the counties of Riverside, San Bernardino, in addition to San Diego. Our main office is here in San Diego. And we have lent about, I will say this, including this month, about 65 million and over $1 million in COVID relief loans. Our COVID relief loans right now our funding is already finished. So we are finished with that program. There has been talk that there's going to be another program coming, but we have no details on that. We're funded by federal and local agencies, by banks, foundation, and anyone that wants to donate money to our wonderful organization. Now, when we're talking about identifying strength as a borrower, these are the things that any lenders are going to be looking at. And they are called the 5 C's of credit. You have probably heard about them. They are character, capacity, collateral, capital, and condition. So under character is who are you, what kind of experience you have in the industry that you have to decide to get into. What is your credit? What is your score? How is your history? Are you current on all of your financial obligations? So all of those things are part of your character. So we're going to be looking at that. In terms of capacity, do you have a steady source of income that can support your loan payment? And remember, or just to let you know, we do what is called a global cash flow analysis. So we use not only the revenue from the business, but we also look at your personal income. If you have a job, if you have a pension, or any other source of income that you may have, or your spouse, if your spouse is part of the business, or even if your spouse is not part of the business, but you want to bring her in for strength, you're welcome to do that. Capacity is basically your ability to make the payments on the loan. If the capacity is weak, we're going to ask you if you have a co-borrower that you can bring to strengthen that C that you are missing. If you don't have that co-borrower and we cannot overcome that hurdle, we're going to have to decline your application, or any lender will do for that matter. Now, in terms of collateral, when you think about collateral, think about property that you might have that can strengthen your application. For lenders like Accessity, we're going to be looking for vehicles that are paid off, that you own free and clear, that we can put a lien on and provide some strength to the loan. So if you have no collateral, that is not a dead deal. Basically, it's just a one more strength that you might have in your toolbox to provide for us to be able to approve you. So if you don't have any collateral, well, hopefully the other C's are strong enough that you won't need to be strong in that C. So it's also important to know, where the collateral is, because in the event that you are not able to pay the loan, the lender will take possession of that collateral. So if you own a home and you took a loan, your lender put a lien on your house. So if you don't pay your house, of course, they're going to take possession of your house and do what is called well, you know what that is called. I don't remember. Now, there is also materiality. Materiality is very important, because if you have assets that are worth nothing, well, no one wants to take that as collateral, right? If you have a what is it called? A vehicle that is worth $2,000 and you want a $100,000 loan, we're not going to take that vehicle as collateral, because it's not the value of that collateral is not significant. It's not material, really, to give strength to that loan. So in terms of capital, is basically your skin in the game, right? So what are your savings that you may have? You may have a 401k that you don't want to touch, right? You might have a pension you don't want to touch, but you have that money available in case something happened that with the business, right? You want to have that cushion. But so capital is your skin in the game. If you have savings, that is a strength. So if you go to a lender and you say, I want $50,000 and to start a new business, and you have no money to start the business, they're going to say, why you're going to start a business without funding, right? So remember, your lender is going to take a risk as well. So is the lender going to take 100% of the risk? That is going to be very difficult. So if you come to me and you say, Rosalinda, I have 50,000 and I want another 50,000, that means we are going to be taking 50% of the risk. So sometimes we might ask you for down payment. For example, if you are going to buy a truck and need $80,000, we're going to say, do you have $8,000 to put, like a 10% as down payment? So to know, basically to put some skin in the game. Now, also, we're going to make sure you have your closing fee. So you cannot finance the closing costs on our loans. Some other lenders you might be able to, like, for example, when you go buy a car, they ask you, oh, you want to put these additions to your car, these other things, and they, the first price of the car was maybe $30,000, and then after you put all these other things on your car, like a long-term guarantee and things like extended warranty that you put in all that, they just put it all in your loan, right? They finance the whole thing. So you don't need to you might not need to put a down payment. You might need to put a down payment, but it might be very small. But those things can be financed. So some lenders allow that. Some lenders basically require that you pay the closing costs up front. We are one of them. In terms of condition, the purpose of the loan is going to play a huge role in the loan approval. What do you want the money for? Oh, I want the money for working capital. Well, working capital can be so many things that you have to have a a defined use for that funding. When you go to the lender, you can say, if you say working capital, you're not showing really much. You're not really sure what you're going to use the funds for. You know you need them, but you don't know what you're going to do with them, or you don't want to share that information, right? So it's definitely important that you provide a breakdown of the use of funds, because that will show the lender that you have a plan, that you know exactly what you're going to do with the money. Now, another thing that might affect your loan is the economic environment. What is happening? What is happening in the economy right now? If there is recession, if there is an inflation, if whatever is happening, well, that's also going to affect your type of industry, right? If there is a shutdown tomorrow because of COVID and all these restaurants are closed, and we know that is going to happen, that is going to represent a higher risk for our borrowers that are in that industry. So all those things will affect your application. Now, also the business have to make sense. If you come to us with a very unique, innovative idea that we cannot really understand, that's going to be very difficult, because you need to make sure your lender understands what you are doing. We need to understand where are we putting our money. Same with any other lender. So the business have to make sense. That's why if you are a startup business, you need to provide a business plan, because that's going to have a detailed explanation of what is it that you're going to do with the funds. Now, I'm going to go to the next slide, but it's interesting. I was looking for quotes for my slides, and I found this one that was very interesting. If you don't care about your credit, if you don't take care of your credit, then your credit is not going to take care of you. So when you really need the money and you don't have the credit score or the credit history that you need to get that funding, you're going to miss the opportunity. And we see that a lot, believe me. So monitoring your credit. It's going to be very important that you know what your credit is before you fill out any application. And you can go to Credit Karma and say, but Credit Karma says that I have a 700. But then when we pull the credit, it says that you have 660, right? 40 points different. We have people that say, it's not possible because I check my credit. I'm going to tell you what the difference is. So different credit bureaus and organizations like Credit Karma, they use different models, different credit scoring models. And if you go to Investopedia and you look for credit scoring models, you see all the models that are there. We use the FICO score. So there is a difference in the scoring model. So the one that you might be pulling might be a different scoring model than FICO. So that's where the difference is. You might also see differences between credit bureaus. But in Equifax, I have 700, and in Experian, I have 660. Well, that could be because Experian is the most conservative credit bureau, and most of the banks pull your credit in Experian. Now, remember, you can go to annualcreditreport.com and get a free copy of your credit report from each of the bureaus for free once a year. So you can monitor your credit year round. Every 3 months you pull your credit report and you are monitoring your credit. You know what's in there. And there are not going to be any surprises when the lender tells you, oh, you have a delinquent account. I didn't know that. So if you monitor your credit, you will avoid that kind of thing. Now, your credit has several components, and I'm not going to go much into it, but you need to make sure you don't close your credit cards, right? You might stop using them, you might cut them off, but don't close the account. Let the institution that issued that account close the credit card. That is, if you have too many credit cards. The more credit cards you have, the more difficult it is to manage your credit. Now, keep your utilization, your credit card utilization below 30%. If you have a credit limit of $3,000, make sure you don't charge more than $1,000 a month. Because if you do that, your credit score will be over 700, as long as your other payments are done on time, like your car, your mortgage, and those things. You want to make sure you are never late on your mortgage or your car, because those are things that you need, right? You need your house to live in, and you need your car to move around. So if you're not able to pay your house or your car, how are you going to pay a loan for a business? So those are the things that lenders are thinking, and I'm sharing that information with you today to empower you, so the next time you approve for a loan, you get approved. Now, you also don't want to have more than 3 inquiries on your credit. Remember, when you pull your credit yourself, that doesn't count for your credit score. So it's not going to decrease your credit score, affect your credit score. But every time you fill out an application for credit, by law, that lender has to do a hard pull on your credit, and that will affect your credit. So what do? Do a lot of research to find the lenders that will be more flexible to be able to lend you the funds that you need for your business. Okay. This another of the C's, right, is capacity to pay. So when we analyze your capacity to pay, we're gonna use this formula, and I'm gonna give you this formula. This is called the global cash flow analysis. So there is something called business cash flow and something called global cash flow. Global cash flow is when we include your personal income. We do that to give you more opportunity to be qualified, right? So if you have a job and you have a business, well, you might be making more money in your job than in your business, but you want the loan for your business. So, or maybe you want to bring your spouse and your spouse is making good money. So all that is going to give you more capacity. So you see here, if we are going to determine the business debt service coverage ratio, we're going to look at the business revenue and we're going to look at the business expenses. Then we're going to divide the business revenue divided by the business expenses. You're going to get the ratio. Okay, the debt service coverage ratio. Now, if we add your personal income to your business income, that becomes your global income. In this example, we have that the global income is $17,000 per month. And then you have your business expenses. We add your personal expenses, your monthly debt payments, and we will get to the global monthly expenses, which are $15,000. So what that means is that your discretionary income is $2,000 every month, right? So if your discretionary income is $2,000 every month, can you make a payment on a loan that is $2,500 a month? No. Can you make a payment of $1,500 a month? Maybe. That's more doable because what you have left over every month is $2,000. That is your discretionary income that you can spend at your own discretion. So if we divide 17,000 divided by 15,000, you will get to 1.13. That is the global cash flow ratio that you have. So this is basically what the lenders will do. Now, let's suppose you started a business a year ago and you had certain expenses that you know you're not going to have again because you bought a big piece of equipment that was $8,000. You bought a vehicle for the business that was another $15,000. So you have there $23,000 that you're not going to spend next year. So when we're doing this global cash flow, we're going to try to add that back. So, okay, we have expenses here that are one-time expenses. We're going to make adjustment to those expenses to give you more opportunity to get approved. We're going to add back, for example, depreciation. That is an expense that you might have on your business P&L or profit and loss, but it's not a cash out expense. It's basically an expense that are going to reduce your profit, but it's not, you don't have to disburse those funds at any time. It's the depreciation of your equipment. Now, cash flow is king. Okay, so you can have other strengths, but if you don't show the ability to make the payments, you're not going to get approved, because it's an essential part of the 5 C's of credit. At this point, when we are talking about global cash flow, and we see that you don't cash flow. So for example, if you have a global cash flow of 113, we might approve you, right? Because we know you have capacity to pay. Now, if we talk about the debt service coverage ratio, we know that also the business have capacity to pay. So both have capacity to pay because they can meet the loan payment. So we're going to be approving people. Some banks will use 1.25. Other lenders will use 1.0. Other riskier lenders might go to 0.98. I will say that's, you won't see that much, right? But it has to be more than 1% ratio for you to have a better chance to get approved. So this is a formula you can use yourself if you pull all of your information and know if you can pay the loan or not. So you might think you can, but in reality, you might not be able to. Now, in terms, what are the documents that the lenders are using? In terms of documentation, you're gonna fill out an application. You're gonna provide your copy of your ID, because we need to know who you are. We need to know, to make sure you have a business. So we're gonna look to see the registration of your business within the state or a DBA or whatever type of registration you have. We're gonna look at bank statements. Why? Because the bank statements can reveal a lot of information to us. It will tell us what your balances are, what are basically the average balances that you keep there all the time. We can see if you have any NSF, overdraft fees. We can see how you spend your money. You can see the deposits, how the money comes in, where it comes from. So there is a lot of information that your lender will see from your bank statement. We are able also to see if those bank statements have not been changed, right? Because sometimes we get applications when they send wonderful financial statements, but the math doesn't add up because they have used certain softwares and they have changed the numbers. That is by the way, that is the immediate decline. When we see that, we currently are using a third-party service that basically you authorize them to send us your bank statements, and they will send us the bank statements directly. We saw a lot of fraud during the pandemic. So people were desperate for money. They will do anything to get funding. So these are the things that make lending a lot more difficult, because we have to be aware of a lot other external factors that don't play a role in the actual calculation of your capacity to pay. We're also going to ask for financials. So if you come to me today, I'm going to ask you for your financials of this first 6 months of the year, which are your balance sheet and your profit and loss, or your income statement. So those are the only two financials that we ask for. And you need to have them ready. So if you don't have them ready, don't fill out that application, because you're going to delay the process. And we might end up withdrawing your application because you might not have it ready. Also, you might think your accountant is going to be available to you to do it tomorrow. And, accountants are very busy and they might not be able to get to you in the next couple of weeks. So keep that in mind. If you are doing QuickBooks or any other accounting software, you can easily print that information if all of your entries are up to date, if you have entered all of your transactions. Some lenders ask for the debt schedule because they want to see a breakdown of all the business debt. So this is very important. Your personal debt is usually on your credit report. We're also going to ask for 2 years of tax return. These are the tax returns, are the documents, right, where you report your income and your business profit to the IRS. Okay, so if you underreport because you don't want to pay taxes, that's going to show less capacity, and you need to submit all the complete tax return. Yesterday, for example, I received a tax return, and the client said, "No, I don't have a business. This is my personal tax return." Okay, and clearly I could see on the schedule 1040 that he had a business, because there is a line item that says that you have a business, right? Business income. And he didn't know that, and he kept saying that he didn't have a business. So that was an automatic decline because he didn't know that we could see that. So transparency is super, super important. Keep that in mind. Now, if you are a startup business, we're going to look at a business plan and projections. So we want to know who you are, what is it that you're doing, what is your marketing plan that is going to make you successful. And we only require that for startup businesses because we don't have a history. Now, banks won't lend to startup because they want to see at least 2 years of history, and they want to see profit. They cannot take that kind of risk. But as a nonprofit mission-based lender, we are able to take a lot more risk. Now, as I said before, the breakdown of the use of funds is important. If you have a collateral, you need to show that you are willing to pledge your collateral. I tell you, if you have a collateral that you don't plan to sell, that will be a great way to build strength and reduce your interest rate, by the way, because every strength is going to make your file stronger. Now, if you are opening a location or acquiring a business, we're going to require that you show your lease agreement. We want to know how long you plan to stay there, right? Or at least a letter of intent from the landlord that they're willing to lend you to rent you the place. We want to see what your rent is going to be, because we want to make sure it's a reasonable rent for the area and the square footage is priced adequately, and that you're going to be able to make that payment of your lease. Simply put, your job is to prepare yourself and your business for growth. Okay, and that's from a book, The E-Myth Revisited, which is a very good book. Now, if you have a co-borrower, we're going to request the same information from your co-borrower, and they will also have to apply as well. Make sure you ask your business development officer how to do that, how to bring your co-borrower into your application, because they cannot just go online and apply. You have to bring them into your application. Now, all owners of the business that own 20% or more have to be on the loan. So if you have a friend that have a business and he wants you to come in as a partner, and he said, I want you to come in as a partner, I want you to bring $20,000. That's not going to work because he needs to be on the loan as well. And that is just not going to work unless he's on the loan. So keep that in mind. Anyone that owns 20% or more of the business needs to be on the loan. You might want to take a personal loan and do an injection of the business, but the business loan is for the business. It's not for you to buy into a business. Okay, so you want to know what kind of lender you need to approach. Banks give you the best interest, right? Banks are great, but not many people qualify, especially tiny businesses, micro businesses, like the majority of our businesses here. So they want to make sure it's an established business over 2 years. They want to see profit. The pandemic happened, yes, but they still want to see profit. They cannot take risks. There's a lot of banks right now that are not lending to small businesses. So make sure you ask your banker, your business banker, are you doing business loans? What kind of loans are you doing? Are you doing lines of credit? Are you doing equipment loans? Are you doing vehicle loans? You want to make sure you ask those questions. And also they want to look at your financials. They want to look at your taxes. They want to look, your credit has to be over 680 to be able to access capital from a bank. So it's a lot more difficult because they like to do big loans. They like to do, they are national banks. They like to do big loans. These small loans, a lot of them, they cannot do them, and they refer them to organizations like us, CDFIs. Now, your best bet after a bank would be probably a CDFI like Accessity, especially if you were a startup. If it's a high-risk business like a restaurant, a trucking, retail, those are higher risk. Or if you just want a small amount of money for your business. Also, e-commerce, equipment, those are things that that we can do, or any CDFI might be able to do. Now, in terms of asset-based lenders, these more work better when you have accounts receivable or purchase orders that they can finance those. And basically, this happens a lot in the manufacturing construction industry and government contractors, because the government takes quite a bit of time to pay these contractors. So they need to pay their employees. They need to pay for materials. They need to pay for, whatever it is that they need to pay, but they're going to need that cash now. And the government is not going to pay until everything is done, or until a month later or 2 months later. So asset-based financing might be a good strategy and a good option for those kinds of businesses that are usually B2B. Now, revenue-based lenders, they basically take the repayment of the loan with a percentage of the sales. This happens a lot when you have big in the entertainment industry. For example, they're going to do a big concert, right? They need money right away to do all the setup and the planning, but they're not going to get their funding until sometime later. So they do revenue-based financing. So special projects are also fall into this category. Alternative lenders. There is a lot of lenders out there that you might see online, that they show up in your feed, that they're going to give you money the next day. That could be an option too, but keep in mind, you need to ask for the APR. And now there is a law that requires that they share their APR. If you see that their APR is over 30%, that is considered a predatory loan. I'm just sharing that information with you to protect you. Now, if you want to find responsible lenders all over the nation, go to connecttocapital.com. They will match you with the best lender for you. And all the lenders that are in that platform are, to this point, they are responsible lenders, or CDFIs like us. And let me tell you, there are over 260 CDFIs just in the state of California, and there are everywhere in every state. So if you go to Connect to Capital, you will be able to find a CDFI in your area. Now, why you don't want to do? You don't want to delay the process. So make sure you have all the documentation ready. We like to give you about 5 days to submit documents. So make sure you have everything ready. If you don't have everything ready, don't apply, because then that application is going to be withdrawn. And not only that we already pull your credit. So make sure you have all your documentation. Avoid borrowing before speaking to the experts. So we have a team of business development officers ready to talk to you and kind of talk about your particular situation and let you know if we are able to fund you or not, or what are the chances. This is difficult. I still think you should apply because there might be a small chance, or this sounds like a great deal. I don't see why not, right? So we're going to give you a pretty good idea if we believe that this is a doable deal. Avoid spending the funds without final approval. Don't spend the money because what if something happened at the end? I have been driving to deliver a check, and if it has been 30 days after the application, we have to do another credit pool. We usually do a soft pool. So if we do a soft pool and you have more debt, right, they might say, no, we have to stop the disbursement of the loan. So it happened to me. I was driving to close a deal. They told me, no deal. We're not closing the loan because the person got into more debt, right? So don't sign the lease before receiving the funds. I cannot start to tell you how many people make that mistake, and they sign the lease that for 5 years, and then they're not able to open the business, and they have to file bankruptcy to get rid of that lease. So keep those things in mind. Refinancing your home, you don't want to be going through a refinance of your house and applying for the loan at the same time. You will be denied by both because the lenders don't want to see anything happen when they are doing the underwriting. They don't want anything happen. And if you incurred in a debt recently, they're also going to ask you. If they see a debt that you took 3 months ago, they're going to ask you, what was that? How come you're asking for more money when you asked for money 3 months ago, 4 months ago? There is another loan on your credit. Don't apply for a new credit card. That will drop your credit score. Don't quit your job or change jobs when you're going through underwriting, okay? Because that can also be an issue. Don't commingle. If you have a business, put all the money from your business in your business. Separate business and personal. A lot of people keep cash at home. Oh, I do a lot of cash transaction. I keep the money at home. I don't deposit it because I don't want to report it. They have a lot of mattress money. And then you come and tell, no, Rosalind, I have like $50,000 at home under my mattress. Really? So if I cannot see it, I cannot count it. So that money needs to be in the bank. So to increase your chances to be approved. Then again, now don't make any large purchases that you may deplete your funds and then you show no capacity. Remember the formula, right? So wait for those large purchases because the cash flow will be affected. Don't lose your credibility like the guy that submitted those tax return insisting that he didn't have a business when I could clearly see it on his tax return. Be transparent. Be transparent with your lender. We'll find it. There is a lot of process that we go through that even without looking is going to reveal things that will affect your loan application. Now, our program is I'm going to go through the next slides very quickly. This is Accessity's loan program. We lend from 300 to 100,000. This is a 2 to 3 weeks process after you submit all your documents. And we have a rapid loan up to 8. That one can take 5 days. The regular loan is going to take longer because the rapid loan we don't send to underwriting. Now the rates are 6.99 to 14.99. Is based on the 5 C's. There is no prepayment penalties. It's simple interest and fully amortized. We have no application fee. Now you get a maximum term of 6 years. You don't determine the term. The lender, the underwriter will determine the term, but it gives you an idea of more or less what term you're going to have. If you're going to borrow $10,000, they're not going to give you 6 years to pay $10,000. It's going to be more like 3 years to pay $10,000. So depending on the amount and your capacity to pay, they're gonna basically pick the term. Now, the cost of our loans are about 6%. That is our fee. 6% of the amount that is approved of the amount that you take. That fee is basically you only pay that if you take the money. Okay, and 3% of that is our processing fee. The other 3% it goes to the state of California for the guarantee that we get to protect that loan. So that guarantee protects the lender, so we can stay in business. Okay, if you are a veteran or an active military, you will get a discount. And let's go to the next slide. Make sure you consult your experts. We have excellent resources in Southern California, the Small Business Development Center, the Women Business Center. SCORE has mentors that you can have for 4 years and meet with your mentor every single month. They are free to you. Or you can pay for those services. You can go to your banker, right, and consult with them. Your CPA, have the capacity to help you analyze your finances, or your attorney, for that matter. If there is a particular situation, like you need to register your business, you have a situation with your corporation or your articles of incorporation or your bylaws, anything of that kind, you might want to consult your attorney. This is our website. Feel free to visit us. We have a lot of resources there, so go and explore our website. These are the people in my team, the business development officers. They are here to help you. They might be in your area. I actually cover the LA and Orange County region at the moment. So feel free to reach out to me as well. I'm going to open it up for questions. It's just Susan, we have questions.
Yeah, so if anyone wants to write their questions in the chat box, and I'd be happy to ask them to Rosalinda. There was one question pertaining to if somebody has issues with credit, like there's something on their credit score or on their credit report that they want to contest, or their overall credit score is not where they want it to be. What do you recommend that person does?
Well, if you reach out to us, we can refer you to a service that actually we pay. We pay this service so they can help our clients become loan ready. There is a third party called Trust Plus. It's a nonprofit budget management organization that can help you take care of those things. They will do that for free. I will warn you, some people get into this credit monitor services that they pay a monthly fee. I would not recommend that, to be honest, because you can fix your credit yourself, and you just need to be guided. And through Trust Plus is a resource that we offer that you can be guided. You might find the resource on our website. Otherwise, reach out to me, and I will definitely send you to them at no cost to you. So keep that in mind. But there are resources. There are people available to help you with your credit. Basically, they will provide a financial coach that will meet with you via Zoom, and you go over to credit. They do a soft pull. It doesn't affect your score because it's a soft pull. You're not applying for credit with them. You're just requesting counseling, coaching with your credit. If you follow what they tell you, you should be able to fix your situation. Some things are very easily, you just have to pay them. Or some things are, if you have a problem with a particular vendor, or that you don't see that it gets solved, there are actions that you can take, and that's what the coach is for. Any other questions?
Yeah, there's another question. Are there types of businesses that Accessity or other lenders cannot fund? I know we get a lot of questions about product development, real estate investment in particular. Can Accessity work with those types of businesses or other lenders? And if not, why?
Very good question. So there are certain industries that we call them forbidden industries, right? Let's talk about cannabis and hemp. Okay, so they are not approved at the federal level, and we receive federal funding. For that reason, we cannot use federal funding to fund those type of operations. Product development is another one that Susan mentioned. So if you are an inventor coming up with a product, we never know when that product's going to be, you are going to be able to launch it. Because, you know, people have come up, oh, I need 10,000 for product development. We give them the 10,000. 6 months later, they come to borrow more money because they haven't been able to finish the product. And what happened? You get in debt, but how are you going to pay it eventually? So we want to help businesses that are launching, ready to launch, you know, that are going to be generating revenue right away because they're going to be able to pay the loan, right? At the end of the day, the lenders want you to pay the loans. Every lender have their own policies. I will say another thing that we don't fund the purchase of weapons. We don't fund adult entertainment. We do not fund animal reproduction clinics. We do not fund art galleries. And we're talking about art galleries per se. Okay, so there's several, and there's a list of what we call forbidden industries that we don't participate. Flipping, if you want to buy, that is very speculative. So if you want to put your house in Airbnb and you want to remodel the bedroom and buy furniture, we don't do that because you have a mortgage on that house. You can go and get a line of credit for home improvement, or you can refinance your mortgage, or, you know, so we don't do that. If you're that indirect sales, right? If you're a Mary Kay director or a Lula Road representative or a Herbalife Nutrition Club, those are things, they're not really your business. You are basically an independent distributor, but it's not really a business that you created. So those are the type of businesses that we are not going to fund. So those are some that come to my mind at this time. There's a few others. So make sure we don't fund lenders. So if you're a lender that want money to lend, we cannot lend you money. We don't lend you money. Usually financial transactions like that I'm going to flip homes, things like that, we do not fund. Anything that is speculative or ideas that might be, wow, I don't even understand what they're doing. You know, if we don't understand the business, we're not going to be able to fund it. Any other questions, guys? We're running out of time.
Yes, I know we're running out of time. Just a couple more questions and we'll wrap up here at 5 o'clock.
Go ahead.
So if somebody, I know you had mentioned working with a banker. If somebody knows they're not ready for bank financing quite yet, how do they get connected with a banker, and how would they start working with them if they know they're not necessarily ready to take out a business loan at a bank, if maybe they're more a better fit for Accessity's program?
Okay, well, when you need a banker to open your business account, because you need to have a business account, because you're not going to use your personal account to put your revenue, because that will be commingling. And I said you have to avoid commingling. So you need a business bank account. So that's how you go to the bank, say, okay, I need a business bank account. You are assigned to a business banker. So you can ask all the questions that you want to that business banker, and you make sure you ask for a business banker, because they have more experience handling business. And if not, you make an appointment and you come another day when the business banker is at the branch, right? And they can help you. They can tell you, oh, we need an EIN, you need a DBA, you need this, you need that to open your business account. These are the fees, whatever. But you start talking to that person and building that relationship. So if you need a loan, they should be able to refer you to a community development financial institution like Accessity. If they don't, at least you know that we exist. Or you go to Connect to Capital. If you are outside our area, you can go to connecttocapital.com and find that lender. That platform will ask you about 15 questions, and they will do a match with the best lender for you.
Thank you. And then one last question. Someone has a detailed question that I can send you those details after, but in general, the question is that they're asking about if they have a current Accessity loan, are they able to refinance their loan? Is that something we offer? And how would they go about doing that?
Okay, yes, you can refinance your loan as long as you need more capital, you have the same or better credit, and you prove that you have the capacity to pay, and you have and your business is growing. Remember, when we talk about loans, the loans, people say, oh, your loan is very expensive. Or no, your loan is great because I tried to apply somewhere, they were charging me 15% or they were charging me 30%. So some people have more experience doing business loans than others. For your loan is going to be expensive if you use it for something that is not going to yield returns. For example, I want a loan to pay my credit cards. Why are you going to pay closing costs on a loan to pay your credit cards? That's expensive, right? But if you give me a loan, Rosalinda, I can duplicate my sales, because the only thing that a loan does make you get there faster. That's it. So you can wait and get your money and then reinvest it and get your money. But if you're able to get a loan and buy in bulk, or produce more product, or or have bigger sales, it's going to let you go there faster. So that's what loans are for, to grow your business. So we're going to be paying a lot of attention to what the purpose of the loan is, because we want to create jobs. We want to build businesses. So we want to make sure the funding goes to businesses that are growing and they're thriving. I know some people were affected by COVID. We will look at that too, because if you survive to this point, chances are that you deserve the help. Okay, so give us a call, contact one of our business development officers. They are all here on this page that I haven't moved, so you can take a look at. We're also going to receive the deck. You have that information. Here is my direct information. You feel free to send me a text or just call our main number, 619-795-7250, and we'll